for CS Professional, old syllabus, Financial, Treasury and Forex Management. So if you know, let's try to make this event interactive. So if there is anything you want to ask, the chat window is there and you can definitely put your questions in the chat window, and that way, and whatever question I do ask from you, I suppose that you are going to answer those questions. All right, guys. I hope you are not seeing any green patch over here when I'm reading any of the. I hope your view of this, my screen is clear. All right, guys. So here we go. I'm your mentor for the day. I'm Tarun Mahajan. I'm Chartered Financial Analyst from CFAI USA, and I am a professional since year 1999. 21 years back, I qualified as a chartered accountant also, and I have been teaching this subject, financial management, since last 21 years. So here our purpose is to make a revision of approximately half of your syllabus of financial, treasury and forex management. So if I see how I have planned, total 3 sessions I'll be taking. Today it is the first day and I'll be taking for approximately 3 hours, and then on 3rd of July again I'll be taking for 3 hours, and then on 5th of July, whatever date it is, 6th probably, yes, 6th of July, again I'll be taking for 3 hours. So total 9 hours session I'll be taking for you. I have divided this 9 hour session like this. Like in today's session, I'll try to cover introduction to financial management, time value of money, and capital budgeting. Okay. In the next session, and I'll try to cover it up in 3 hours time. That is in today's session only. In the next session, I'll be taking leverages, cost of capital, and capital structure theories. I'll try to cover it up in the time limit of 3 hours. And then in the last session, I'll try to cover working capital management and dividend policy decision within a time period of 3 hours. Working capital management also comprises a part of debtors management and also a part of cash management. And yes, some ratio analysis part is also there. Okay, so all these chapters we'll try to revise in a manner so that in the examination it becomes easy for you to revise these chapters. Here we go, guys. I'll start with time value of money. Introduction, we are making a revision. So introduction, we can cover it later. You all have at least studied this subject once. I'm assuming that you all have at least studied this subject for once. And that's why kind of you have the basic idea of all the concepts. Okay, meanwhile, I just make you a request that if you post anything in the chat window, then please post the chat to all the panelists, not just only to the presenter, but to all the panelists, or maybe to the presenter and the host. It's like this. Okay. All right, great. So here we go. Time value of money. This is not exactly a chapter of your syllabus. What do you study is actually capital budgeting. and you also study derivatives chapter. You also study portfolio management. In derivatives, in portfolio management, in foreign exchange risk management, in capital budgeting, in all these chapters, the concept of time value of money is actually used. And that's why it's really good to have an understanding of time value of money chapter. So I wish that you are also carrying a calculator like this, an ordinary calculator. Maybe it is a Casio or a Citizen calculator. So I'll be telling you some of the shortcuts which may be used on your calculator. You know, some calculators do not support the shortcuts. In that case, you will have to derive it yourself that what your calculator actually supports. Okay, guys. What is time value of money? A rupee today is more valuable than a rupee a year hence. What does it mean? If suppose you have to recover rupees 10,000 from me, and I give you two choices, either to recover it today or to recover it after 1 year. So definitely you will choose to recover it today only. Because if you get the money today, you can invest that money somewhere and you can earn some interest. Say if you receive 10,000 rupees today and you invest it at the rate of 10% per annum, then in 1 year's time, this money will become 11,000 rupees. On the other hand, if I make payment to you after 1 year, I'll give you 10,000 and your 10,000 will be 10,000. But if you get it today and invest it for 1 year, then in 1 year time, your 10,000 will become 11,000. That's why it is preferable that you receive money today. Now, a question is, if you receive money today, you will invest that money and you will earn interest. The question is, should you charge interest? If you give loan to somebody, should you charge interest at all? If you buy debentures in a company, if you buy bonds in a company, should you charge interest at all? That's a question. If you make investment in equity shares of a company, should you ask for some return? If you buy preference shares in a company, should you ask for some return? Why do you ask for return on your investment? Why at all? Are you a greedy person? You know, in Hindi, there is a term which is named as soodkhor. One who earns interest may be named as soodkhor. So are you a soodkhor type of person who makes his living on interest? No, it's not like that. Why do you charge interest? Actually, the reason is there. You are not greedy. You are not soodkhor. You are charging interest because there is not one single reason. In fact, there are three reasons. When you give your money to me as a loan, you are not able to consume your money today. Say, with 10,000 rupees in hand, you were planning to buy a new mobile phone. No, you already have one mobile phone, but you wanted a new one because the old phone is, kind of, its hardware configuration is not up to the date. So you wanted to buy a new phone. You were going to buy a new phone. And meanwhile, I arrived at you and I said, give this money to me as a loan for 1 year. And you gave that money to me. Now you are sacrificing your current consumption. You're making deferment of your consumption. And whenever somebody makes deferment of consumption, it's a kind of sacrifice. And for this sacrifice, he will ask for a compensation. He will say, I made a sacrifice for you. You need to compensate me. And that's why people do charge interest, compensation for deferment of consumption. Number 2 is inflation. Number 2 is actually inflation. What is this now? If you give that money to me and I return your money after 1 year, and then you go to buy the mobile phone, probably the mobile phone will cost 10,400 rupees after 1 year, which is today costing you 10,000 rupees. So your money will have less buying power when I give it back to you. You will suffer from inflation. And that's why you will ask me to give some compensation for inflation also. Say you're charging 2% per annum. because you're sacrificing your current consumption, you're making deferment of it. You're charging 4% per annum because you're suffering from inflation. So you will charge at least 6% per annum from anybody. Even if you purchase Government of India bond, which is considered to be a risk-free security. Have you ever gone through it in portfolio management? The CAPM model, RF plus RM minus RF into beta. You can say yes. Let's have an interaction, buddies. Do you know the concept of CAPM model? Capital asset pricing model. And the formula is RF plus RM minus RF into beta, isn't it? Through time value of money. Let's try to explore that formula also. Okay. So even if you're giving your money to Government of India, which is the safest investment in India, still you will be charging 6% per annum. You know why? Because you're suffering from inflation and you have to make deferment of your consumption. But when you give this money to me, Tarun Mahajan, a chartered financial analyst, a chartered accountant, a registered valuer, I'm telling my qualifications so that you get impressed and you are ready to give me money. So you give money to me. So, okay, I'm asking you one question. Will you give me money at the rate of 6% per annum? Say yes or no. I'm reading your chats. Will you give me loan at the rate of 6% per annum? Come on, quick to answer it. Oh, some of you are saying yes and some of you are saying no. Let me tell you, the right answer should be no. I don't have a credibility equal to Government of India. I don't have a credibility equal to State Bank of India. Maybe I can make default in repayment of your money. And that's why you should not be ready to give me money at the rate of 6% per annum, because you give me money, you bear a risk. Okay. And for that risk, you will charge the risk premium and say that risk premium is 6% per annum. So in total, you'll be charging 12% per annum. Try to recall even the CAPM equation. What does it say? RF plus RM minus RF into beta. What is RF? RF comprises these two elements: compensation for deferment of consumption, and number two is inflation. These two things added together becomes the risk-free rate of return. And then RM minus RF into beta is actually the risk premium. Here in this example, I straightway told you that the risk premium is 6%. But there must be some method to calculate the risk premium. And that is RM minus RF into beta in case of equity share. RM is return on Sensex. RF is the risk-free rate of return. So if Sensex is giving 15% per annum, if risk-free security like government bond is giving you 6% per annum, then those who are investing in Sensex, they are getting 9% risk premium. They are getting 9% extra return. And this extra return is actually named as risk premium, But you don't charge 9% risk premium when you make investment in equity share. You multiply it by beta. And what is that beta? It is the risk index. It is the regression coefficient. If beta is 2, it means that the risk you are bearing is double as compared to the risk of the Sensex. So 9% is risk premium for Sensex. Multiplied by beta 2, you deserve 18% risk premium. Plus RF is 6%. You deserve 24% interest. You deserve 24% return from your investment in equity shares. So I hope now you understand that why do you charge interest? Why do you charge dividend? Why do you ask for a rate of return when you invest your money somewhere? And due to this desired rate of return only, you are able, that is why the time value of money concept is there. If the interest is 0, there will not be any time value of money. Say interest rate is 0% per annum. I give you 10,000 rupees today. You invest it for 1 year. After 1 year, you'll get 10,000 because interest rate is 0. In that case, there will be no time value of money. Time value of money exists because there exists the concept of rate of return. Now, the question is, how do I calculate it? So, the formula to calculate future value is like this. See here, it is FV is equal to PV into 1 plus R to the power n. Here FV stands for future value, PV stands for present value, R is the rate of interest. It is small r, that's why it is not in percent, it is point. So instead of saying 12%, I'll say 0.12. And n means number of periods or number of years, you can say. I hope you already know how to make power n. If you don't know, I'll quickly tell you. Say I want to calculate 10,000 into 1.12 raised to the power 6. Come on. Quickly calculate it and tell me the answer. Can you tell me the answer? Can you be quick enough to calculate it? Oh, that's quite slow. So the calculator keystrokes. I'm sorry. Calculator keystrokes are like this. You type 1.12 and then you multiply it. Just a second. You type 1.1, oh, 19738. Fantastic. You type 1.12 on your calculator, press into 1 time and then press equal to 5 times. And then multiply it by 10,000 and press equal to. And yes, exactly, Surinder. In that case, you'll be getting an answer of 19738. Perfect. If you want to make power 6, you press equal to 5 times. If you want to make power 4, you press equal to 3 times and so on. Now let's do the reverse calculation. How to calculate present value of a single amount. If you are supposed to receive 19,738 rupees, you know what is interpretation of this? If you deposit 10,000 rupees with somebody who is giving you 12% interest, if you make a fixed deposit with NBFC, which is offering 12% per annum compounded annual interest, then your 10,000 in 6 years will become 19,738. Now let's do the reverse calculation. If you want 19,738 rupees after 6 years, how much money should you deposit today? So in that case, your calculation will change like this. And here you'll make the power 6 actually. Just a second, please. Give me a moment. Yes. So now there are 2 ways to calculate. First, you calculate power 6 and then you divide it. Or first you can calculate the present value factor. That is present value of rupee 1. And the thing is very simple. You do 1 divided by 1.12. And then you press 6 times equal to. And you get 0.5066. Can you check it for me? And then you multiply it by 19738. And the answer will be approximately 10,000. So in case of future value, you press 1 equal to. but your number of 1 into, but your number of equal to's will be less 1. Power 6 equal to 5 times. Power 4 equal to 3 times. Power 3 equal to 2 times. But while calculating present value, if you want to make power 4, you need to press equal to 4 times. If you want to make power 10, you need to press equal to 10 times. This is about future value and present value of a single amount. Now let's talk about future value and present value of annuity. What is annuity? My first question is. So I'll say annuity is a, series of cash flows where all amounts are equal and time gaps are also equal. So let's say this is year 1 and 2 and 3 and 4 and 5 and 6. And amount is like this. Say in the first year you are getting 100 rupees, second year 100, third year 100, fourth year 100. Is it an annuity? Say yes or no. See, number 1, it is a series of cash flows. Number 2, all the amounts are equal. Number 3, all the time gaps are equal. And therefore, I can say that yes, this is an annuity. But if I say this is 200 and this is 300, now this is not annuity because the amounts are not equal, even though the time gaps are equal. Or if it runs like this, suppose first year 100, second year 100, third year nothing, fourth year 100, fifth year nothing, sixth year 100. This is also not an annuity because the time gaps are also not equal. So what do we wish is that time gaps are equal and amounts are equal. Then that series of cash flow is actually named as annuity. If you want to calculate present value of annuity, in that case, the formula looks like this. This is the formula. So present value of annuity is equal to amount of one installment multiplied by 1 minus 1 upon 1 plus r to the power n divided by r. Here r is obviously rate of interest and n doesn't mean number of years. Mind it. N means number of installments. So say, let's take this example only. Let's calculate present value of this series at the rate of 10% per annum. I hope you already know how to calculate this. So can you quickly tell me the answer? 100 rupees, which is receivable at the end of first year, second year, third year, fourth year. If you quickly give answer to this, I'll assume that you already know this. So I'll skip it and move to the more advanced concepts. 100 rupees you will be receiving at the end of first 4 years at the rate of 10%. And now you have to calculate present value of the annuity. One thing is for sure that present value of this annuity will be less than 400 rupees. A bare sum total is 400. So it's going to be less than 400. So here I put 100 and the rate of interest will be 10%. In denominator also it is 10%. And power n, I'll make power 4. In capital budgeting question, this will be very much required to calculate NPV of the project. The calculator keystrokes for the same. It's very simple. 1 divided by 1.10, 4 times equal to, and then you deduct 1. After doing 4 times equal to, you deduct 1 and thereafter you divide it by 0.10 and press equal to. Oh my God, you have not yet done it? Come on guys, quickly do this. This is quite a simple calculation. You must be getting minus 3 point, yes, Surinder. You must be getting minus 3.170 or 16170. Yes, let's round it off. Ignore this minus sign and now you simply multiply it by 100 and you'll get 317. Yes, the right answer is 317. So what is the calculator trick for calculating it? 1 divided by 1.10, 4 times equal to minus 1. 1 divided by 1.10, 4 times equal to will solve this portion. Then you deduct 1. So it is for this part of the formula. Then you divide by 0.10. So it is for this part of the formula. And then you get 3.170, which may be named as present value annuity factor. Yes, it is present value annuity factor, that if you are receiving 1 rupee for each of the 4 years, its sum of present value is not 4 rupees, it is 3.17 rupees. And then finally you multiply it by 100 because it is not a series of 1 rupee, it is a series of 100 rupees. So I hope now everybody got this answer, 317. I'll tell you a further shortcut which will run quite faster. So you just do it with me on your calculator. Okay. Are you ready? Get, set, go. Turn on your calculator. 1 divided by 1.10. 4 times equal to GT multiplied by 100 equal to. Got the answer? This calculation should not take more than 5 seconds. You can put a timer. 1 divided by 1.10. 1, 2, 3, 4. GT into 100 equal to. And you'll get 316.9865. Actually, when you press GT, it makes a sum total of factor for the first 4 years. And when you make a sum total of factors for year 1, 2, 3, 4, you get annuity factor for 4 years. So this is a faster way of calculating. 1 divided by 1.10, 4 times equal to grand total multiplied by 100 and press equal to. This is how you can quickly get present value of annuity. Okay, great. One can also calculate future value of annuity. Then there is present value of annuity due. Then there is present value of deferred annuity. And many more things can be done. But I'm not going to do all those things. I'll rather tell you something else. So let's say I'm giving you a quick question and you have to calculate sum of present value of these cash flows. So this is a capital budgeting project where if you make investment, you will be getting first year 5,000, 6,000, 7,000 and 8,000 in first year, second year, third year and fourth year. Can you calculate? Okay, first answer me one question. Is it an annuity? Say yes or no. I'm waiting. No, it's not. Okay, but you have to calculate present value of this series of cash flows and make a sum total of it. Okay. So tell me. Let's see how fast you can do it. Calculate sum of present value of all these cash flows. Come on, guys. That's quite slow. You know, in examination, you will be short of time. So you need to speed up. And we are going through this time value of money concept because we want to speed up. 20227. Exactly, Vinaya. Very nice. No, Shruti, it's not 21429. Vinaya has given the right answer, 20227. I wish everybody should calculate it. Come on, guys. Okay. So let's do one thing. 20226. Right. 20269 Rashmi is getting. Priyanka is getting 20226. I'll tell you how to do it. See, the calculator keystrokes I'll give you here. First, one should type, 5,000 and then divide it by 1.10, press equal to, and then n plus. And then 6,000, 2 times equal to m plus. And then 7,000, 3 times equal to m plus. And then 8,000, 4 times equal to m plus. And finally, when you do MRC, you will get this 20227. If you wish, you can note down this shortcut. Look, how do I do it? Let's do it together and I'll tell you what is the logic behind this shortcut. The first of all, there is a switch on your calculator, MRC. When you first time press it, memory is recalled. When you second time press it, memory is cancelled. So press MRC 2 times so that if there is anything stored in memory, it is cleared. Now turn on your calculator. Just do it with me, okay? Come on. Type 5,000 divided by 1.10 equal to. As soon as you press equal to, you get present value of this amount, 4545. And then I press M plus. You know why M plus? Later, I won't have to make a total of all these amounts. I'm keeping all amounts in memory, all present values in memory, so that later simply memory recall will help me and I won't have to type all these amounts to make a sum total. Now 4545 is appearing on the screen of your calculator. Let it appear and you simply type 6,000. Now your calculator is intelligent enough that your last operation was division. So now you need not to specify divided by 1.10. You simply press equal to 2 times. It means what you have done, 6,000 divided by 1.10, 2 times equal to. That is present value of second year's cash flow. And then press M plus. So this is already stored in memory. And then type 7,000 and 3 times equal to, which will give you 5259, which is third year's present value, M plus, and then press 8,000 and 4 times equal to, and M plus, this is fourth year's present value. And when you recall memory, actually you're making a sum total, which is 20227. So this is how it works. You know, in your calculator, there is one wonderful thing. KYC. Know your calculator. So I'll tell you one wonderful thing about your calculator. If you know your calculator properly, it will help you a lot. In your calculator, if you do A plus B and then keep pressing equal to, in that case, B becomes constant. Excuse me. Okay, just do one calculation with me. 2 plus 3 equal to, it must be 5. Then press equal to again. And it will be 8. And press equal to again, it will be 11, 14, 17, 20, 23, 26, so on. What does that mean? When you do A plus B, B becomes constant. Okay, now do 100 minus 2 and keep pressing equal to 100 minus 2. 100 minus 2 will actually give you 98. And when you press equal to again, it will be 96 and so on. Now you can do 100 divided by 2. You must be getting 50. Then again equal to 25, 12.5, 6.25 and so on, So B becomes constant. Okay, now be careful and do 10 multiplied by 2. You'll be getting 20. And again equal to is 200. And again equal to is 2000. So when you do A multiplied by B, then A becomes constant. In all other operations, the second number, that is actually B, becomes constant. Take advantage of this concept and this will enhance your speed. You can derive your own calculator shortcuts if you know your calculator properly. Okay, fantastic. Okay, now, thank you. Now I'll tell you one thing, which is something like this. Just a moment. How to calculate, rate. Suppose, as you know, that the formula is future value is equal to present value. Sorry. Future value is equal to present value multiplied by 1 plus r raised to the power n. Okay. And now suppose I'm telling you that if you make a fixed deposit with me of rupees 5,000, I'll give you rupees 10,000 in 5 years time. Deposit 5,000 rupees with Tarun Mahajan, and Tarun Mahajan will give you 10,000 rupees in 5 years time. What is the rate of interest implicit in this offer? Come on, quick. I'll give you 1 minute and your time starts now. Come on, calculate the rate. There are two ways to solve it, either the trial and error method or some mathematical calculation. 20%. Okay. I don't think so, Vinaya. See, I'll tell you the mathematical method first. Then you can use trial and error also. You know, I'll increase the font size. If you make some calculations, then it will be 2 to the power 1 by 5 equal to 1 plus r. How to make 2 to the power 1 by 5 on your ordinary calculator? Do you know that? Say yes or no. Okay, Vinaya know it, Sakshi doesn't. Okay, some people know and some don't know. So I'll quickly tell you. Yes, the calculator method. You just need to type 2. Oh, yes. Come on. And then square root it. Type 2 and press under root switch 12 times. I hope you must be getting 1.000677 something like that. Then deduct 1. If you deduct 1, 12 times under root, okay? If you deduct 1, you will be getting 0.00067771. Then multiply it by 1 by 5. So multiplying by 1 by 5 actually means dividing by 1.5. So you'll be getting 0.0001354, something like that. And then you add 1. If you already know it, then you should quickly do this so that we can save on time. Then you can simply add 1 and you'll be getting 1.0001354. And then make a square 12 times. How to make a square? You press into and then you press equal to. That is square. So you do that 12 times. Into equal to 1, into equal to 2, so on. 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. This is not 1 point. This is wrong. You must have told me this is not right. 0001692 this is. Come on guys, you need to give me calculations. So you must be getting this 1.1487 equal to 1 plus R. So R is actually equal to 0.1487 or 14.87%. Okay. In examination, it is not preferable that you do it like this, but you can quickly once do it like this, and you know the answer that it is 14.87%. Now you can show the trial and error that I'll do one trial at the rate of 15%, other trial at the rate of 14%, and then I will do the interpolation to arrive at the exact answer. So with the help of this example only, we can do the trial and error calculation also. So the second way of solving this question is by trial and error. And in fact, we'll be using that only. Because in capital budgeting also, you'll have to calculate, but how do you know to square root 12 times? Okay, that's a long story. That's a shortcut that you need to memorize. Whatever power you have to make, power 1 by 3, 1 by 5, 1 by 6, 1 by 7, this way is fixed. Under root has to be done 12 times and later square has to be done 12 times. 12 times under root minus 1 divided by the power plus 1, 12 times square. This is fixed. Why 12 times exactly? That's a deep root of differential calculus. And differential calculus is much beyond our scope. Okay, you again want to see the solution? Sure. So this is the solution. Now, method 2. This is trial and error. Here, what do? I'll try one rate, say 15%. Now I have the hint, so I can take advantage of it. If I calculate future value using 15%, so it will be 1.15. Future value will be 1005657. Better I say. Can you just check it at the rate of 15%? Is this the future value? But I don't want 10,000. Okay. One more question is there. I'll address that. Could you please explain how 1.1487 comes? Yes. Yes, Tyagarajan, I'll tell you. It's very simple. Once you got this figure 1.00003384, then you need to make square 12 times. How to make square one time? Press into and equal to. Once you have typed 1.00003384, then into equal to one time, again into equal to second time, then into equal to for the third time, then into n equal to, multiply n equal to, fourth time, then multiply n equal to fifth time. Do it 12 times and then you'll get this figure. Is that clear, Tyagarajan? Okay. So trial 2. I don't want 10,057 rupees. I just want 10,000 rupees. So now I am reducing the rate from 15% to 14% because I want to reduce future value. So 1.14 and then I press into 4 times equal to into 5,000 and I get 9627. So here the difference I am getting is 57 rupees. And in this case, the difference I am getting is 373 rupees. Difference from my target value, which is actually, my target value is actually 10,000. Once I've done this, then I will use the interpolation formula. And here is the interpolation formula. This is the formula. Okay. So how do I get the exact rate? I start with the lower rate. Among 15 and 14%, the lower rate is 14%. Plus the difference in case of lower rate. In case of lower rate, difference is 373. In case of lower rate, difference is 373. In case of higher rate, difference is 57. And then I multiply it by 15 minus 14. So when I solve it further, it's gonna be 373 plus 57 divide equal to into 373, 14.867%. This is the interpolation formula which will be helpful in capital budgeting chapter while calculating internal rate of return, IRR, internal rate of return. Okay. I hope this formula is clear to you. Lower rate here, we have made trial with 2 rates. You know, why did we make trial with only 2 rates? Because with 1 rate, we are getting the answer above the target value of 10,000. With other rate, we are getting the answer below the target value of 10,000. So once you get one answer on the higher side and one answer on the lower side, thereafter you can do interpolation. If both of your answers are above 10,000, you cannot do interpolation. If both of your answers are below 10,000, again you cannot do interpolation. You can do interpolation only if one of the answer is above the target and one of the answer is below the target. How to decide what should be the lower or the higher rate? That's quite simple. There are 2 rates, one is 15 and one is 14. So among 15 and 14, 14 is the lower rate. And then once you choose this is the lower rate, then difference in case of lower rate is 373 DL. And difference in case of lower rate plus difference in case of higher rate into higher rate minus lower rate. Okay, fantastic. Oh, you mean how to choose the rate for trial and error? And for that only I have told you, you should first do this 12 times under root method. And once you do this 12 times under root method, on your calculator, it will not take more than 30-40 seconds. So in 30-40 seconds, first you can do this and then you know the answer exactly. And thereafter you can show the trial and error of 15 and 14%. You know, in examination, they usually give you 2-3 rates. They do publish some of the rates with the question, and that will give you a kind of hint that if 3 rates are given 14, 15 and 16, then I should start my trial with one of these rates only. Okay, great. Next. So these are some concepts of time value of money which will be used in capital budgeting, which are used in portfolio management and derivatives also. And now let's talk about the most complicated chapters. One of the most complicated chapters, better I say. This is capital budgeting. Rashmi is saying for choosing the rate, we can calculate PV factor. No, that's not going to help you. It's better you use your question is stuck at one point. How to start trial and error, at what rate to start trial and error. As far as examination is concerned, the trial and error thing is very simple. They will publish 2-3 rates for you. So you can start your trial and error with that rate. If they don't publish, then in the last example, what you could have done is you calculate it by 12 times under root method and you'll get a hint that where should I start trial and error. PV factor is not going to help you anyway. Okay guys, now let's talk about capital budgeting. So I must tell you one thing about it. Wait a minute. Just a second, please. The next question, next chapter now we are starting is capital budgeting. Capital budgeting is actually an investment decision. If you look at the word capital budgeting, it is capital and budgeting. What is budgeting? Budgeting means planning for future. In cost accounting, you study budgeting, which is just only for a period of 1 year. And it includes only revenue items. But here we will be planning for next 5, 10, 15, 25, 30, 40 years. And we will include not only revenue items, but also capital nature items will be included. And that's why this chapter is named as capital budgeting. This is nothing but long-term investment decision. I'm the CFO of a company and I have to take a decision. Should my company invest money in a new venture, in a new business or not? So actually, I try to predict the future of that project. And if the future looks bright, then I make investment. Otherwise, I don't make investment in that project. Okay, this is how I do it. So capital budgeting decisions are, really very important decisions. Why capital budgeting decisions are important? In your life, you take many decisions. Right from morning till evening, daily you take many decisions. But those decisions may or may not be important. Capital budgeting decisions are very important. Why? Number one, substantial expenditure. You're investing money in a project, say 5,000 crore rupees of investment. And if your decision goes wrong, and even if you make a 20% loss on your decision on 5,000 crores, loss will be huge, 1,000 crore rupees. That's not acceptable. When a huge amount is involved, you think twice. In fact, you think 10 times. You make a proper analysis, then only you take a step. Then the long-term consequences are there. Some decisions, if it goes wrong, it will irritate you for some time only. But some decisions, if they go wrong, they will irritate you for the lifetime. So the capital budgeting projects are not like you started today and after 10 days you feel like, oh, this is not what I like, so I would like to reject it. No, not at all. You cannot do it. It takes years to start and it takes years to shut it down. It's a very long-term consequence. And irreversibility. If your sum of decisions go wrong, you can correct it by reversing the decision. So you bought a two-wheeler and after 2 months you feel like it is not of my type, you can sell it out in the second-hand market, in the used vehicle market. But for capital budgeting projects, it's not easy. You cannot reverse it. It's very complicated. So a huge amount is involved, long-term consequences are there, and the decisions are mostly irreversible. Therefore, you need to take these decisions very carefully. Whenever a capital budgeting proposal is in front of you, you need to make evaluation of the proposal, whether it is a good proposal to make investment or not. So, proposals are mainly of two types. I would like to cut this one. This is not really important. One is independent proposal and other one is mutually exclusive proposals. What are independent proposals? Where the decision of one proposal does not affect other. Like all of you are going to appear in examination in some time. So if one student passed the exam, then remaining student at that examination center will not fail in the examination because it is not a competitive exam. All of you can clear in the exam if you score above 50% in aggregate. And God never happens that all of you may fail the exam. Some of you may pass and some of you may fail in the examination. You are not competing with each other. Anyone who scores 50% or more will be declared as passed. So you all are independent proposals for Institute of Company Secretaries of India. Then what are mutually exclusive proposals? That's like a competitive exam or that's like a job interview. Once you clear the examination and you become a company secretary, then you go for a job interview and there are 5 candidates for one post. If one is selected, remaining 4 are automatically rejected for that post. That indicates mutually exclusive proposal. Okay. So how do I take decision in case of mutually exclusive proposals? I make evaluation of all projects and select the best one. The best is selected, remaining are rejected. How do I take decision in case of independent proposals? Here, I evaluate each of the projects, and if all are profitable, I'll accept all. If some are profitable, I'll accept some projects. If none of the project is profitable, I'll reject all the projects. So the decision in case of independent proposal is based on some cutoff, some threshold point. Like in case of NPV, the cutoff is 0. 0 and above, proposal is accepted. Below 0, it is rejected. In case of IRR, if it is more than cost of capital, accepted. If it is less than cost of capital, rejected. In case of profitability index method, if it is 1 or more, it is accepted. If it is less than 1, it is rejected. So the decision is based on cutoff. Okay. So if I try to list the methods which are techniques of evaluation, better I say, how do I make evaluation of a project which is in front of me? So broadly, there are 7 techniques of evaluation: payback period method, discounted payback period method, payback reciprocal method, net present value method, internal rate of return method, profitability index method, and accounting rate of return method. Out of these 7 names, only one method is based on profit. If you ask a layman that how will you take investment decision, he will say if the project is profitable, I will accept it. So he's looking at profit. But now you are a pro, you are not a layman. You'll say I'll look at cash flows, not at profit. Out of 7 methods, only one is based on profit. Remaining 6 methods are based on cash flows. Cash flows. Oh yes. Because the word profit is quite confusing. They change in accounting assumptions, accounting policies, and accounting standards. Profit can change, but cash flow remains the cash flow. And that's why it's more reliable. The question arises, how do I calculate cash flows? Okay, so that's quite simple. How do I calculate cash flows? say, let's start with sales. Oh yes, based on past trend, future is forecasted. Okay, you want to see the screen of methods again? So actually I have divided techniques. One technique is based on profit, which is ARR. Other techniques are based on cash flow. Then in cash flow also I have divided it into two parts. One is non-DCF, where you don't calculate present value, that is payback and payback reciprocal. And others are DCF, discounted cash flow techniques, where you calculate present value of cash flows, discounted payback period, net present value method, internal rate of return method, and profitability index method. Yes, so I'll have to make a prediction of future cash flows. So I don't directly make prediction of future cash flows. I try to predict sales. And suppose sales is expected to be rupees 5 lakh. Will you share this material? I don't think so that I'll get the opportunity to share this material. Everything is given in your own study material issued by ICSI. So whenever you feel like you need it, you need something, you feel something new is over here, you can take a screenshot. Okay? Or you can visit my website fmbytm.com, financial management by tarunmahajan.com. Over there also you will find maybe many notes and other things. Okay, so cash expenses. Cash expenses, mind it. I'm not taking non-cash expenses like depreciation and everything. And suppose cash expenses are rupees 3 lakh. So my cash profit is 2 lakh. Okay. Cash profit, let's name it as cash profit, cash flow before tax. I'll name it as cash flow before tax. CFBT. Because this is cash profit and tax has not yet been deducted. You know, if the amount of tax is say 40,000 rupees, so 2 lakh minus 40,000 will become 1,60,000. That will be cash flow after tax. But in most of the questions, say if somebody tells me that amount of tax is 40,000, then I will directly say that cash flow after tax is 1,60,000. But in most of the questions, they don't make you available amount of tax ready-made. And actually, you will have to calculate amount of tax. And if you want to calculate amount of tax, for the purpose of tax, depreciation is a deductible expense. And suppose depreciation here is 50,000 rupees. So once I deduct depreciation, you know, what do I get? This cash flow before tax may also be named as profit before depreciation and tax. So once I deduct depreciation, I'll get profit before tax, which is 1,50,000. Then I will calculate tax, say at the rate of 30%, and that will be 45,000. So I'll be getting 1,05,000, and this is profit after tax. Now, once the tax purpose has been solved, depreciation is a non-cash expense. It should not be deducted. I will deduct it. I have deducted it, so I'll add it back now. I'll add it back. Now, 50,000 rupees. And this is my cash flow after tax. This is how you make calculation of cash flows. And in capital budgeting, usually I divide cash flows into some parts like annual cash flows, which happens every year, and then there are initial cash flows, which happens only at the beginning, that is purchase of land, building, plant, machinery, furniture, fixture, investment in working capital, etc. And then there are terminal cash flows, which happens at the end only. What are initial cash flows? Investment in fixed assets and investment in working capital. What are annual cash flows? So this is the calculation. Sales, cash expenses, depreciation, income tax, everything. This is annual cash flow. What is terminal cash flow? That is disinvestment. Once the project is done, you will sell out the scrap of plant and machinery. You will demolish the building or sell out the building, and you will sell the land also. You will realize the amount invested in working capital. That happens only when the project is over, when it is done, when its life is finished. That is terminal cash flow. At year 0, whatever happens is the initial cash flow. At year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, whatever happens is the annual cash flow. At year 10th, whatever happens lump sum once in a while, that's the terminal cash flow. Initial cash flow is once in the life cash flow. Terminal cash flow is once in the life cash flow. Annual cash flow is recurring cash flow. It happens every year. Initial cash flow is very simple. I invested 5 lakh in land, 10 lakh in building, 5 lakh in working capital, total investment 20 lakh. Terminal cash flow is also very simple. My realization of land is 3 lakh, of building is 3 lakh, of working capital is 5 lakh, 3 plus 3 plus 5, 11 lakhs. But annual cash flow is quite complicated, and this is how you actually calculate annual cash flows. It is not necessary that the question will give you sales and ask you to calculate the Cfat. Rather than they can give you Cfbt and ask you to calculate Cfat. That is also possible. So there may be some shortcut also for calculation of cash flows. Now what are those shortcuts? I'll tell you. Look, Cfat, cash flow after tax. If I start with cash flow before tax, then first I deduct depreciation. Okay, before that I'll tell you one more thing. There is one shortcut. Profit after tax is equal to profit before tax minus tax. I hope you agree. So profit after tax is profit before tax minus, how do I calculate amount of tax? It is profit before tax multiplied by tax rate. How do I calculate amount of tax? It is profit before tax multiplied by amount of tax rate. So, a shortcut can be like this. Like here, my profit before tax was 1,50,000 and tax rate is 30%. So 1 minus tax rate is 70%. So 1,50,000 into 0.7 gives me 1,05,000. So keep in mind the shortcut PAT is equal to PBT multiplied by 1 minus tax rate. I hope that's quite clear. So how do I calculate CFBT? I start with CFBT, then I deduct depreciation. Now CFBT minus depreciation is actually profit before tax. Profit before tax multiplied by 1 minus tax rate is profit after tax. Profit after tax, add back depreciation, will give you cash flow after tax. What do you say? Do you agree with this? Okay, now I will simplify this. I'll open the bracket. So it is CFBT multiplied by 1 minus tax rate minus depreciation multiplied by 1 minus tax rate plus depreciation. Now I'll open this bracket also. I'll open this bracket also. So this will become CFAT no, is equal to CFBT into 1 minus T minus depreciation and minus minus plus depreciation into tax rate plus depreciation. You know, now what will happen? This depreciation and depreciation will be cancelled. So finally, I'm sorry. CFAT is equal to CFBT into 1 minus T plus depreciation into tax rate. So this is the shortcut. You take the cash flow before tax and simply make it after tax and consider tax benefit on depreciation separately. Why do you deduct depreciation? You deduct depreciation, then you add it back. So you just want to treat it for the purpose of tax. You can consider tax benefit on depreciation separately. So how do I do that? See, in this example only, CFBT is 2 lakh, okay, and depreciation is 50,000. CFBT is 2 lakh. So 2 lakh multiplied by 0.7 and depreciation is 50,000. So plus 50,000 multiplied by 0.3. So that is 1,40,000 plus 15,000. And the answer is 1,55,000. That is same as before. So that's the quicker method of doing the question. CFBT into 1 minus T plus D into T. This is how you calculate cash flow after tax. But you know, what do you do in case of loss? If there is a loss, then you will have to carry forward that loss. There are two ways. Either you can set it off in the same year or you will have to carry forward the loss. Let's take just one example of 15, probably this one. Not this one. 10, 10, 20, and 80. Okay. So, you know, this is profit. Profit before tax is positive. How to deal if profit before tax is negative? I'll tell you how to deal when profit before tax is negative. Look, initial investment is 1 lakh. Why minus sign? Because that's going to be outflow of cash. Now, life of the project is actually 4 years. So I'll make column like year, CFBT, PBT, and then tax, and then PAT, CFAT. 1, 2, 3, 4. Yes, done it. Okay. Now suppose question has given us CFBT, and that is 10,000, 10,000, 20,000, and 80,000. Life of the project is 4 years. Salvage value is nil. Initial investment is 1 lakh. Terminal cash flow, that is salvage value in this case, is 0. And now you have to calculate cash flow after tax. So CFBT, can you tell me depreciation is to be charged on straight line method? Come on, quickly tell me the amount of depreciation for each year. Help me to quickly solve it, please. Amount of depreciation. Shruti is saying, oh yes, fantastic. Cash flow before tax, then I deduct depreciation. So cash flow before tax minus depreciation, 25,000. That will give me profit before tax. 25,000 I am deducting from each year. And 25,000 will give me 55,000. You know, now there are two ways to treat it. One is to carry forward the loss. One method is to carry forward the loss, and the other method is to set off the loss in the same year. Okay. So if I carry forward the loss, I won't have to pay any taxes. But the amount of carried forward losses is 15 plus 15, 30. 30 plus 5, 35,000. 35,000 loss has been accumulated in 3 years. In 4th year, first I'll deduct 35,000 of loss from this 55,000 of profit to get taxable profit of 20,000. You know, 55,000 minus 35,000 of carried forward loss, that will give me 20,000 rupees of taxable profit into 30%. I'll have to pay probably it is 40%. Say tax rate is 40%, say for example. So I'll have to pay 8,000 rupees. Let me check what is given in the question. Oh yes, it's 40%. Rupees of tax I have to pay. No, rupees of tax I have to pay. Why? Because 35,000 is carried forward loss and my taxable profit is just 20,000 rupees. 20,000 into 40% will give me 8,000 rupees of tax. So now my profit after tax is going to be 15,000 negative, 15,000 negative, 5,000 negative, and 55 minus 8 is 47,000 positive. And my cash flow after tax, I add back depreciation 25,000. So it will be 10,000, 10,000, 20,000, and 72,000. This is what happens when I carry forward the loss. But if I decide not to carry forward the loss and I decide to set off the loss in same year. Sir, how can I set off the loss in same year? See, that's simple. If you want to set off the loss in the same year, in that case, you know, you will have to do one thing. And that one thing is actually like, wait a minute. There must be some profit in any other business. See, here I make an assumption that this is not my only business. I do have other business activities also. I do have other business activities also. And in the other business, I'm making profit. So I will set off this loss from that profit. And on 15,000 rupees of loss, 15,000 into 40%, that is 6,000 rupees I'll receive as tax. Here also 6,000 rupees I'll receive as tax benefit. And here 2,000 rupees I'll receive as tax benefit. And here 22,000 rupees I'll pay as tax. So my loss here will be 9,000, 9,000 minus 3,000 and plus 33,000. And when I add back depreciation, 45, depreciation is 25. Oh my God. Oh yes, I have done here 25 only. So it's going to be 25 minus 9. 16, 16, 22, and 58,000. So that is the amount of Cfat. But so usually what do I do in the examination? See, if I make a sum total of these amounts, it's gonna be same. But the amounts are different, 16, 16, 22 and 58. And if I carry forward the loss, it is 10, 10, 20 and 72. So what do I do in the examination? Now that's a question. What do I do in the examination? Which method is preferable? Look, that's quite simple. If the question is silent, then you will always prefer to set off the loss in the same year. You should always prefer to set off the loss in the same year. I hope that's clear. Okay. Now the next concept. Now let's talk about something about initial and terminal cash flow. You know, in one project, fixed assets required is rupees 1 lakh and working capital rupees 25,000. After 5 years, salvage value is rupees 20,000. So what is initial and terminal cash flow? That's the question. What is the amount of initial cash flow? What is the amount of terminal cash flow? Okay, you tell me. What is the amount of initial cash flow in this case? Exactly. Fixed assets 1 lakh. Working capital 25,000. And that's why the total is 1,25,000 outflow. Let's put a minus sign to indicate outflow. Okay, can you help me with terminal cash flow? Terminal cash flow 45,000. Some people are saying 45,000. Some are saying 20,000. And the right answer is 25 plus 20, that is 45,000. Moral of the story. Moral of the story is, whatever amount of working capital is invested initially, the same amount is realized at the end. There is no depreciation in case of working capital. Initially, if you are investing 25,000 rupees, at the end you will realize 25,000 rupees. In case of fixed assets, usually you receive a lower amount. But in case of working capital, usually you receive the same amount. Whatever amount you invested, you will be receiving the same amount from working capital. If working capital keeps fluctuating, in that case, how do I deal it? So I'll quickly create one example for you. Oh, I'm sorry. So this is, say, year. This is working capital. This is cash flow. So in year 1, working capital required is 25,000. I'm sorry, in year 0, because when you start the business, working capital is required at that point of time. Then it rises to 45,000 level because there is expansion in business. Then in second year, it remains same as 45,000. In third year, the level of business reduces. The working capital requirement also reduces to 10,000. In fourth year, it remains at 10,000. In fifth year, level of working capital becomes 0. Okay. Now tell me the cash flow due to working capital from year 0 to year 5. What will be 0 years amount? Inflow, outflow, how much? In 0 year, there will be, yes, 25,000. Okay, tell me first year's cash flow. Will it be inflow or outflow, and how much or nothing, no cash flow will be there? Yes, it will be outflow of 20,000. And then 0. And then there is inflow of 35,000. And then 0. And then there is inflow of 10,000. This is how it's going to happen. So whenever there is increase in working capital, that will be outflow of cash. And whenever there is increase in working capital, this is inflow of cash. Just give me a second. Okay. I hope you got it. Great. So, just a minute. Huh? payback period and discounted payback period. Okay. Wait, I'll create one example in MS Excel that will be, faster to calculate. Wait. Okay. So how to calculate payback period? Suppose this is the example where I say initial investment is equal to 1 lakh, and in year 1, 2, 3, 4, 5, the cash flow after tax you will be getting is 20,000, 30,000, 40,000, 40,000 and 50,000. So first of all, I'll have to calculate cumulative Cfat if I want to calculate payback period. First of all, do you know the definition for payback period? Now we have learned how to calculate cash flow. The next job is to apply the method. The first method for evaluation is payback period method. What is payback period? Payback period is the length of time required to recover initial investment in a project. It is the length of time required to recover initial investment in a project. So in first year I recovered 20,000. In second year in total I recovered 50,000. Then up to third year I recovered 90,000. Up to fourth year I recovered 1,30,000, and up to fifth year I recovered 1,80,000. Exactly. And now I want to calculate the payback period. So I'll say payback period is equal to, look, I wanted to recover 1 lakh rupees. In first 3 years I am unable to recover 1 lakh rupees, but between third and fourth year my 1 lakh rupees initial investment will be recovered. So one thing is for sure, that payback period is between third and fourth year, because 1 lakh rupees is between 90,000 and 1,30,000. That's why the payback period is 3 plus something. So I'll say 3 plus. At the end of third year, what shortage of amount is there? It is 10,000. I want to recover 1 lakh, but I have recovered only 90,000. So remaining 10,000 is yet to be recovered. While in the fourth year, I am earning how much amount? 40,000. Up to third year, 90,000 is recovered, 10,000 is yet to be recovered. That 10,000 will be recovered from fourth year's cash flow. Fourth year's cash flow is 40,000. So it will not take whole fourth year to recover that amount. And I can say payback period is 3.25 years. Okay, Meenakshi is saying the video is blank. I hope the screen is working fine. So even if my video is not there, don't worry. If the screen is working fine, it's fantastic. Okay. So payback period is either 3.25 year, and if you want to express it in terms of month, then 0.25 should be multiplied by 12. So you can also call it, it is, kind of 3 years and 3 months. 0.25 into 12 months is 3 months. Okay, what if I also want to calculate discounted payback period at the rate of 10%? So first I'll have to calculate present value at the rate of 10%. This is just an example. So every data you are seeing here is I have just created. Don't try to search it somewhere that from where come 10%. I am telling you it is 10%. So disadvantage of payback period, You know what is 3 years, 3.25 years? In 3.25 years, you will be able to recover your principal amount invested in the business. But the disadvantage of payback period is that it does not consider time value of money. You're simply adding 20 plus 30 plus 40 plus 40. What is this? First year, second year, third year, fourth year, fifth year. These cash flows are in different steps. You cannot add them together. First, you need to calculate present value of first year, second year, third year, fourth year. And once all the present values are calculated and all the cash flows are at the same platform, thereafter, you can make a total. So the shortcoming of the payback period is that it does not consider time value of money. And that's why the other method, which is named as discounted payback period method. Here, first I calculate present value of cash flows. You just help me with calculation of present value. Though I am doing it on MS Excel, but you can just simply check the calculation by doing it yourself. Okay, I hope you're getting this present values. 18,000, 24,000, 30,000, 27,000, 31,000. Now I'll calculate cumulative present value. So cumulative present value will be 18,000 and then 24,000 and so on. 73,000, 1 lakh, 1 lakh, 31,000. Once I calculate cumulative present value, then I look for 1 lakh rupees. 1 lakh, 1 lakh, 1 lakh. Here I get 1 lakh. So payback period is again between third and fourth year. Because in third year, I'm not able to recover whole 1 lakh. But by the end of fourth year, my recovery is more than 1 lakh rupees. Though it is marginally more, but still it is more. So to calculate the discounted payback period, I'll say 3 plus. Now just see by how much amount I am short. 1 lakh minus 73,000. So the shortfall is 26,972. Okay. So I'll say 3 year plus 26,972 divided by what I'm earning in the fourth year is 27,321. So it's 26,972 divided by 27,321 plus 3. And this is 3.987 years. You know, it will take 3.25 years. Just give me a moment, please. Yes, I was telling you, it will take 3.25 years to recover the principal amount, and it will take 3.98 years to recover principal amount along with desired return. In 3.25 years, only principal will be recovered. In 3.98 years, principal along with 10% interest will be recovered. How do you take decision in case of payback period method? Suppose this is the single independent project and the cutoff decided by management is 4 years. Now come on, quickly tell me, will you accept this project or reject it if the cutoff payback period is 4 years? Exactly, Sakshi, you will accept it. Okay, suppose there are two mutually exclusive projects and B project, that is the other project, has a payback period of 3 years. Say there are two mutually exclusive projects and B project has a payback period of 3 years. Which project will you accept? Yes, Shruti. In that case, B project should be accepted because it has a lower payback period. Exactly. Suppose there is a B project and the discounted payback period of B project is 4.03 years. Then you will accept A or B. Definitely, in that case, you will accept project A. Perfect. Okay, suppose this is the single independent project and the cutoff decided by management is 3.5 years. This is a single independent project and cutoff decided by management is 3.5 years. So should I accept or reject? Don't say A or B. Yes, then I'll reject the proposal. Now I'll give you one fantastic insight about this. Okay, say this is the independent project. This is the independent project and no cutoff has been given. Now you tell me, should I accept or reject the proposal? This is the independent project. No cutoff has been given. Wow, fantastic. Can you tell me why should I accept it? That's the right answer. No cutoff is given. Why should I accept it? Yes, accept it is the right answer, but why? Since there is only one option, money is recovered quickly because payback period is less. Okay, I'll give you one fantastic point of view over here. Life of the project is 5 years. Discounted payback period is approximately 4 years. What does it mean? Within 4 years, your initial amount is recovered, plus your desired return is also recovered. Now still 1 year of life is remained. So in that 1 year of life, you have already recovered in principal, you have already recovered desired rate of return. In remaining 1 year of life, you will be recovering surplus amount. And that's why this project should be acceptable. If there is one independent project and its discounted payback period is less than life of the project, then it should obviously be accepted. You know why it should obviously be accepted? Because within 4 years, you have recovered principal, you have recovered desired return, and still the life remains. So that's the benefit. And that's why I should accept this proposal actually. Okay, now allow me to make one change to this question. And then you need to tell me what is the answer. Okay. I'm making that life of this project is actually 3 years only. Just a minute, huh? I've changed the question now. Now I'm saying life initial investment is 1 lakh. Life of the project is only 3 years. 20, 30, 40,000 rupees are the amount which is recoverable, which is your earning. And salvage value at the end of 3rd year is 40,000 rupees. These are cumulative cash flows. Salvage value at the end of 3rd year is 40,000 rupees. Cumulative cash flows are 20, 50, 90 and 130. Can you tell me the payback period now? in this situation, what is the payback period? Exactly, Surinder. You're absolutely right. The payback period is 3 years. In fact, the discounted payback period is also, it is also 3 years. You know why? I'll tell you, it's very interesting. By the end of first year, I have recovered 20,000. By the end of second year, I have recovered 50,000. By the end of third year, I have recovered 90,000 rupees. And the life is over, the game is finished. And remaining 40,000 I am getting by salvage value. Even if a single rupee of salvage value is required for payback, then payback is equal to life of the project. Now remaining 10,000 will be received from salvage value. Salvage value is accrued, salvage value is received at the end of third year only. You cannot spread salvage value throughout the year because salvage value you always receive at the end. You cannot spread salvage value in 3-4 years period. You receive salvage value always at the end. And that's why this 1,30,000 is there, but it is at the end of third year only. So the payback period is 3 years. The same thing goes with the discounted payback period also. By the end of third year, you have received 73,000 rupees and remaining amount is recovered through salvage value. I repeat, even if a single rupee of salvage value is required for payback or discounted payback, then it is equal to life of the project. So this is one fantastic thing that we need to consider. Okay, after payback and discounted payback, payback reciprocal, I am quickly skipping. I would like to come to the net present value method. Okay. Net present value method. Now, what does it say? I'll tell you. Net present value means actually present value of inflows minus present value of outflows. NPV is considered to be the best method of evaluation of capital budgeting proposals. It is present value of inflows minus present value of outflows. It means if a business proposal is in front of you, you try to forecast all the cash flows, initial cash flows, annual cash flows, terminal cash flows, and after forecasting all cash flows, you calculate present value. And then you net the inflows and outflows to arrive at net present value. How do I take a decision? In case of mutually exclusive, please excuse me for typographical errors if any. In case of mutually exclusive proposals, you will select the proposal with highest net present value. In case of independent proposals, accepted if NPV is positive or even if it is 0. Accept the proposal if NPV is positive or even if it is 0. Here is one example in front of you. Initial investment is 1 lakh rupees. Life of the project is 5 years. Terminal cash flow is 0. And the cash flow after tax is 20, 30, 40, 50, 50. So first you need to calculate present value of initial investment. That is same as 1 lakh rupees because it is already in present at year 0. Then the cash flows are there. You need to calculate present value of cash flow. I have already told you the calculator short trick. You type 20,000 divided by 1.10 equal to M plus, and then 30,000 2 times equal to 40,000 3 times equal to 50,000 4 times equal to, and this 50,000 5 times equal to. So once you calculate this, actually you need not to calculate cumulative cash flows. So I will remove this column of cumulative cash flows. Okay, and I will simply make a sum total of all the cash flows, and that is 1,38,225. Believe it, it is like that. So when I calculate NPV is gonna be like this. Present value of inflows is 138,225. Present value of outflows is minus 1 lakh. So 38,225 is NPV, which is positive, and say this is the independent project. So I will actually accept the proposal. Okay, just allow me to do one thing, which will save our time. Okay, so I have created a new example so that it will be easy to understand. Here the NPV is positive and therefore I will accept the proposal. Let's try to interpret what does it mean that the NPV is positive. Okay, you need to do some calculations with me. Just a moment, please. Here I go. Look, press MRC switch 2 times, then turn on your calculator. Then type 1 lakh rupees on your calculator. Have you done this? Have you typed 1 lakh rupees on your calculator? Okay. Now you are a businessman or businesswoman, as the case may be, and you have given 1 lakh rupees to the business. And you say to the business, look, Mr. Business, I'll come back after 1 year and give me my money back at the rate of, with 10% interest at the rate of 10%. I'm sorry. I'm sorry. You tell business, Mr. Business, I have given you 1 lakh rupees. After 1 year, I'll come back, return my principal amount along with return at the rate of 10% per annum. So on your calculator, type now plus 10%. Is it 1,10,000? Say yes or no. Okay. Now you will ask business at the end of first year, come on business, give me my 1,10,000 rupees. Otherwise I'll see you. Business says, sorry, sir. I'm not able to give you 1,10,000 rupees. But surely I can give you 40,000 rupees. So minus 40,000 equals to 70,000. So at the end of first year, you are still claiming 70,000 rupees from the business. You are saying, okay, today I am going back. You have given me 10% return. You have repaid partial amount. Today I am going back. But second year end, I will come back. And then you need to give me not only this 70,000 rupees, but also 10% return on it. So you don't demand return on your initial investment. You always demand return on the outstanding balance. Keep in mind, you don't demand return on initial investment. You demand return on outstanding balance. So plus 10%. This should be the keystroke. Plus 10%. Is it 77,000 rupees? Yes. So now you're saying business that give me, 77,000 rupees. Business says, sorry, sir, I don't have that much money, but surely I can give you 30,000. So minus 30,000 equals to. So you took 30,000 from the business and you said, look, 47,000 is still outstanding. I'll come back at the end of third year. And you need to give me 10% return also. So plus 10%. Is it 51,700? Perfect. Minus 30,000. So you are asking 51,700, but business is saying, sorry, sir, I have only 30,000 to give you. 21,700 is still pending. 21,700 is still pending. You said, okay, I'll come back after 1 year and I'll recover it with 10% interest. So plus 10%. Is it 23870? Yes. Business will give you not only, business will say, look, no, you talk very rudely. Business is saying you. Now I will not give you 23870, rather than I'll give you 40,000 rupees. That is extra 16,130 rupees. Moral of the story, you recovered initial amount fully. You recovered 10% desired return on outstanding balance of each year. Additionally, you are getting a surplus of 16,130 rupees at the end of fourth year. So are you seeing 16130 on the screen of your calculator now? Okay. If not, then you can type it. If you're seeing, it's fine. Now let's calculate present value of this surplus, 16130. So divided by 1.10, 4 times equal to, divided by 1.10, 4 times equal to, and see the wonderful thing, the present value of this surplus is 11,017 rupees, which is nothing but NPV. Moral of the story, what is NPV? You recover the whole amount, you recover desired rate of return, plus you recover surplus, and that surplus has a present value equal to NPV. And that's why we say if NPV is positive, accept the proposal. And that's why we say even if NPV is 0, accept the proposal, because this NPV is the surplus return you are getting. Yes, but if NPV is negative, then you actually reject the proposal, because that's not a loss. Look, negative NPV is not a loss. Negative NPV is also a profit, but your profit is less than the desired rate of return at the rate of 10%. I hope you got the point. Okay. Now they will keep on putting various complications in the question. The question will become very lengthy and very complicated, but the base will remain same. They will say charge depreciation as per return down value method. So I can demonstrate you one question with return down value method also quickly. And then we will see how to handle projects with unequal lives. Okay, so let's take another example. Where initial investment is again, 1 lakh rupees. and salvage value will be kind of 10,000 rupees. Depreciation on WDV at the rate of 30%. Income taxes at the rate of 25%. Working capital is 25,000. Life of the project is 4 years. And annual CFBT, ready-made cash flow before tax, is, let's say, 40,000. So how do I solve this question? I'll say step number 1 is initial cash flow, where fixed assets investment is 1 lakh and working capital investment is 25,000. So total amount is kind of 1,25,000. Now let's learn how to calculate terminal cash flow also. This is how you can make presentation in exam also. Say terminal cash flows are like this. Salvage value. Salvage value you will be realizing is 10,000, that's inflow, plus working capital realization will be same as initial investment. There is no depreciation in working capital, you know that. One more thing will be there in terminal cash flow. Do you have any idea what extra item will be there? Tax benefit on capital loss. So for that, first I'll have to make one working note. I'll tell you one shortcut to calculate WDV. Shortcut for WDV is equal to cost of asset multiplied by 1 minus depreciation raised to the power n. Oh, I'm sorry. This is similar to the formula for future value. Future value is equal to present value into 1 plus r to the power n. Similarly, here WDV is future value is equal to cost is present value. 1 plus r, instead we are doing 1 minus depreciation because depreciation is deducted. This is a wonderful shortcut. Depreciation is at the rate of 30%. So you need to do it like 70%. 1 minus d will be, a kind of 0.7. 0.7 raised to the power 4 you will have to do. I hope you are understanding what I am saying. So on your calculator, type 0.7, press into, on your calculator, type 0.7, press into 3 times equal to into 1 lakh. And you'll get WDV. Yes, for sure. I'll tell you calculator shortcut once again. So this is one working note I am making. So on your calculator type 0.7, then you need to press into, then equal to, equal to, equal to. That will make 0.7 raised to the power 4. 3 times equal to, na? Okay. Then multiplied by 1 lakh and press equal to. And you will get 24010. Why 0.7? It is 1 minus D. D is 30%. 1 minus 0.3. Okay, if you don't want to go through shortcut, just do it on your calculator other way around. Do it with me. Type 1 lakh minus 30%, then again minus 30%, then again minus 30%, then again minus 30%. That way also you will get it. Minus 30%, minus 30%, minus 30%, minus 30%. Keep on doing that. Then also you will get 24010. Okay. Now, once you got WDV, then you will have to calculate loss. You're selling it for 10,000 only. So loss will be your sale price minus WDV. That is the book value. You're selling it for 10,000 while WDV is 24010. So loss is actually 14,010 rupees. And whenever there is a loss, you'll get tax benefit. Whenever there is a profit, you pay tax. Whenever there is a loss, you receive tax. So at the rate of 25%, 3503 kind of figure will be there. So this is one working note. So 3503 with a plus sign will be here. I'll get 10,000 rupees by selling the asset, and I'll get 3,500 rupees for tax benefit on capital loss. And 25,000 by realizing working capital. Now look, I'll have to calculate present value of this 38,000 also. Present value, say the discounting rate is 10%. I'll put this information here. Suppose the discounting rate is 10%. Okay. So how to calculate present value of 38503? While calculating depreciation, we will not deduct salvage value from 10,000 from 1 lakh. Oh yes. Jyoti is probably, it's Jyoti, I think. Jyoti is asking, is it not cost minus salvage value? Look, whenever the rate of depreciation is given 10, 20, 30, 40%, you don't do cost minus salvage value. You directly do cost multiplied by depreciation rate. If rate is not given, then you do cost minus salvage value divided by life to arrive at depreciation. But when rate of depreciation, say 30% is given, you directly apply it on cost. Keep in mind. How to calculate present value? You type 38503, then divided by 1.10 and 4 times equal to. 38503 divided by 1.10, 4 times equal to will give you 26298. You know, equal to 4 times equal to 26298. So we have done 2 steps. One is initial cash flow, which is 1,25,000 outflow. Then present value of terminal cash flow also we have calculated. Okay. And now here we go for step number 3, which is annual cash flows. And in between we made one working note also. Now step 3. Annual cash flows. For annual cash flows, I'll have to make a table for 4 years like this. And then I'll say CFBT. Question says CFBT is, 40,000. And then I'll have to put depreciation and try to recall. Once you know CFBT and depreciation, you can directly calculate CFAT. And that shortcut was CFAT is equal to CFBT multiplied by 1 minus tax rate plus depreciation multiplied by tax rate. And then I will calculate present value at the rate of 10%. Just do it with me on your calculator. I'll tell you all shortcuts. Don't worry. So calculator keystrokes, okay, for depreciation. For depreciation, my calculator keystrokes will be like this. I type 1 lakh into 30%. That's 30,000. Huh? So I'll write 30,000 over here. And then I'll press minus equal to. So as soon as I do minus equal to, I get WDV, return down value, which is 70,000. So I will again do into 30%. Okay, when I do into 30%, I get 21,000. And then I do minus equal to. And I get 49,000. So I'll repeat the process. Into 30%, which is 14,700. And then I do minus equal to. So I get 34,300 as WDV. And then for the 4th time, I'll repeat this process. Into 30%, which is 10290, and minus equal to same WDV, 24010, cross-checked. 1 lakh into 30% is depreciation, minus equal to is WDV. Into 30%, second year's depreciation, minus equal to is second year's WDV, and so on. Now your keystrokes for CFAT. Look, I am telling you shortcut, so just be aware, just be conscious of what I'm saying. This tax rate is 25%. So 40,000 should be multiplied by 0.75. Manually, you can do it mentally. CFBT into 1 minus T you want to do. So 40,000 into 0.75, tax rate is 25%, is actually 30,000. So CFBT into 1 minus T is, 30,000. So this thing is fixed that this is 30,000. This portion is fixed and this is 30,000. So you just need to do D into T plus 30,000, D into T plus 30,000. So what do? 30,000 into 0.25 plus 30,000. And then you do 21,000 into 0.25 plus 30,000. I'm sorry. Come on, do it quick. 14,000 into 0.25 plus 30,000. And then I do 10290 into 0.25 plus 30,000. If you keep on doing this, your calculation will go very fast. Oh, I've done something wrong. I am sorry for that. I hope you got these figures. Once you do this, then for PV calculation, you already know the formula. Keep pressing equal to, and you will get present value. So here I will quickly give you direct answer so that we can save on time. $1,10,771. You must be getting this figure. You will be getting. Okay, just tell me, the CFD shortcut is clear to you? How to calculate CFD? Is that shortcut clear to you? Say yes or no. No. Okay, I'll repeat it. Don't worry. Just do it with me. See, what do we want to do? We want to do this. CFBT into 1 minus T plus D into T we want to do. Okay. Now, in all four calculations, CFBT is 40,000 into 1 minus T is 0.75 plus depreciation into 0.25. Do you agree? CFBT is constant. Tax rate is 25%. So 40,000 into 0.75 is 30,000. This 30,000 is fixed and you keep it in your mind. Now you just have to do D into T. So do it with me. 30,000 into 0.25 and then add cash flow before tax. 30,000 into 0.25 plus 30,000. Then 21,000 into 0.25 plus 30,000. Keystroke should be exactly what I'm saying. 14,700 into 0.25 plus 30,000. No? Is it clear now? Okay, good. So finally, step 4. I can calculate NPV now. 1,10,000. And this is annual cash flow. This is terminal cash flow. And this one is initial cash flow. And I make a sum total of all these amounts. So total is 12,000. We can do it by PBT plus depreciation. Yes. You can always do it by various methods. But to my mind, whatever I told you is the shortest and the fastest one. You know, increasing the speed in examination is very much required. There are other ways of solving it always, and you can do it. NPV is positive, hence accept the proposal. So this is a full question where capital gain loss, working capital realization, etc. everything is there. A whole lot of such questions can be created. Okay. So now we are good to study other methods like the internal rate of return method. Have you gone through the past examination questions? Do they give present value factors published in your examination paper? Like present value factors at the rate of 10%, 15%, or do you calculate it yourself? They give it now. They give it for selected rates or many rates. 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. They give it for selected rates. Then let's not waste our time. A table is given. And in table, how many rates are given usually? Many rates are given or only 2, 3 rates are given? Many rates are given. Okay. So here we go now. Whole table is given. What is IRR? It is the rate. I will create one example quickly and then I'll tell you what is IRR. So this is one project where cost of capital is equal to 10%. Okay. And you're supposed to, the initial investment is just a minute. Huh? Just a minute. Initial investment is 30,440. Okay. Okay, fantastic. Let's create new example. And you have to calculate NPV. This is the question. So I'll, in single shot, I'll simply calculate present value at the rate of 10%. So present value of this 30440 will be 30440 itself. Okay, now I tell you keystroke for remaining present values. So you just type 10,000 divided by 1.10 equal to M plus, and then again equal to M plus, and then again equal to M plus, and then again equal to M plus, and MRC will actually give you the figure 30444. IRR I will teach later. First I'm telling you the shortcut. First I'm telling you the shortcut to calculate this. So you just tell me NPV quickly. Come on guys, we don't have much time. You need to be fast. Calculate NPV. $9091. Oh, I doubt actually. No, not present value. I'm talking NPV, final NPV. And I guess your final NPV should be 1259 positive. Yes, exactly. Okay, guys, have you used this shortcut which I told you? If the amount is same, the shortcut runs even more efficiently. 10,000 divided by 1.10 equal to M plus. Then for the second year, again equal to M plus. For third year, again equal to M plus. For fourth year, again equal to M plus. Memory recall. 31699 is present value of inflows. Minus 30440 is present value of outflows. And 1258.65 is the NPV. Now, if somebody asks you, how much do you earn? somebody asks you, how much do you earn? And you know what do you say? You say, I earn 10% plus rupees 1259. Now, this is a weird answer. Somebody asked you, how much did you score in executive exam? And you say, I scored 52% marks plus 30 marks extra. How much did you score in executive? You say 52% plus 30 marks extra. What is this rubbish? Either you give the answer entirely in terms of percent or you give answer entirely in terms of marks. So one thing is sure, you are saying, why are you saying that I'm earning 10% plus 1259? Because if NPV is positive, it means you earn desired rate of return and additionally you earn NPV. So one thing is sure that you are actually earning more than 10%. I'm earning 10% plus 1259. It means I'm earning more than 10%. So I do one thing in that case. If I calculate, you don't do it now. If I calculate the whole thing with 11%, then the answer will be 584. So I say I'm earning 11% plus 584. Now this is again rubbish because you're earning more than 11%, but why partial answer in percent and partial answer in rupee? So you try it with 12%. And now you will say, though I am earning 12%, but I'm short by 67 rupees. So again, the partial answer is in terms of percent and partial answer is in terms of rupees. That's not really something good. If you need the whole answer in terms of percent, what do you need is I'm earning IRR percent plus 0 rupees. So what is IRR? IRR is the discounting rate at which present value of inflows is equal to present value of outflows. It means IRR is the rate at which NPV is 0. Sir, why do you want to make it equal to 0? Because I want whole answer in percent and not partial in percent and partial in rupees. That is what IRR is. Now I know that my IRR is between 11% and 12%. Because at 11% I am getting positive NPV, at 12% I am getting negative NPV. I want 0 NPV. 0 is between positive and negative. Now try to recall that interpolation formula. And if I use that interpolation formula, IRR is lower rate. So between 11 and 12, lower rate is 11% plus difference in case of lower rate divided by difference in case of lower rate plus difference in case of higher rate, and the whole thing is then multiplied by higher rate minus lower rate. So this is how we are going to solve it. That is 584 plus 67 divide equal to into 584. 11.897%. This is the IRR. Same concept, what we learned under time value of money chapter. You do trial and error. You want to achieve NPV equal to 0. So at 10% is positive, at 11% is positive, at 12% is negative. So you make a trial between 11 and 12 now. So lower rate is 11. Okay, should it not be 584 minus 67? No, actually we ignore sign and we take modulus. In this formula, you can simply ignore sign and you take modulus. And the answer is 11.897%. And you can cross check it. If I put here 11.897%, look, NPV is almost 0. If I put 11.89, NPV is almost 0. That's a cross check. Now you understand what is IRR. It is the rate at which NPV is 0. Why do you want to make it 0? Because you want the whole answer in terms of percentage. How do you take a decision in IRR? If there are two mutually exclusive proposals, you select the proposal which has higher IRR. But in case of a single independent project, you select it if IRR is equal to or more than cost of capital. Independent project, you select it if IRR is equal to or more than cost of capital, then actually you accept the project. If IRR is less than cost of capital, then you reject the proposal. Okay, what if the cash flows are, not equal? It is like 10,000, 11,000, 9,000 and 10,000 like this. In that case also, the process will remain same. This was for equal cash flows. What if the cash flows are uneven? Like this. No, the process will still remain same. You calculate NPV at different rates. You keep on calculate NPV at different rates. And you'll get the desired answer by trial and error and interpolation. Here I can give you one ready quick answer, but in examination, oh, I'm sorry. But in examination, actually, you'll have to do just trial and error. Okay? But again, a question arises, where should I start trial and error? Now I'm going to tell you something which is my proprietary concept. And it's a bit difficult to understand. But once you understand it, later it will be easy to judge that where should I start my trial. So how to guess the starting point? And I'm telling you one secret over here. And it is approximate IRR is equal to 1.5 times of simple interest rate. Approximate IRR is, now this is going to be difficult, so if you don't understand it, you can simply leave it. But once I'll tell you, I have developed this shortcut which works in most of the situations, but in not all situations. Where should I start my trial and error? So approximate error is 1.5 times of simple interest rate. How do I calculate simple interest rate? That is simple. If I make a sum total of these cash flows, I'm getting 40,000 rupees. So my simple interest amount here is 40,000 minus 30,440, 4 years. 40,000 I'm getting in total in 4 years. You can make a sum total. Check whether it is 40,000, all inflows. Come on, check it. Now, to calculate rate, I'm getting 2390 divided by investment is 30,440 multiplied. So it's approximately 7.85%. Start trial at 7.85% multiplied by 1.5. This 1.5 is fixed and I got it by my research. So don't ask me why 1.5, why not some other rate. That's my research. How can I tell you? Make a sum total of all inflows. Divide initial outflow. Sorry, make a sum total of all inflows. Deduct initial outflow. Divided by number of years. That will be simple interest per year. Simple interest per year divided by initial investment will give you simple interest rate. 1.5 times of simple interest rate will give you a rough idea about IRR. 11.78. So the nearest rate is 12%. You can start trial and error at 12%. This works for all equal cash flows as well as unequal cash flows. Sometimes it may fail, but that's fine because this is just giving you the start point of trial and error, which otherwise also you were trying to guess. Okay, this is IRR. Yes, Anjali. If you understand this, what I told you, then this trial and error will not be any more troublesome for you. I've derived this with my own experience that how does it work. Sometimes, once in a while it fails, but that's fine. Now the next thing is, I'll make a comparison of NPV and IRR later if time allows. But now I'll tell you quickly profitability index method. And this PI is present value of inflows. You know, I observed one thing that some of the students, they don't join it live. And rather they like to watch it later if at all these are uploaded on YouTube. But that's not preferable because once you think it is recorded, I'll watch it later, then that later never comes. And you lose the opportunity to talk one-to-one. So just tell your friends that on 3rd of July and on 6th of July, come here. They should come here. And I'm not aware of rest of the schedule. So that's why I'm saying on 3rd and on 6th July. Tell all your friends, 100% of the people who are going to appear in the old syllabus, and you know them, tell them to be live here so that we can have an interaction. And if more people join, some good questions will also be asked, and that will benefit all the attendees. Okay, so now what is PI? This is present value of inflows upon present value of outflows. You know, in NPV, what do? You actually calculate present value of inflows. In NPV, what do? You calculate present value of inflows minus present value of outflows. Okay. But in case of PI, it is present value of inflows divided by present value of outflows. In NPV, you deduct it. In case of PI, you divide it. Meenakshi is asking IRR concept, ये interest concept and trial and error clear नहीं हुआ. When you complete topic after, repeat that. नहीं मीनाक्षी, आपका सवाल मुझे नहीं समझ में आया. What are you asking? What is not clear to you? The trial and error process or the shortcut of simple interest? What is not clear to you? Okay. So the popular formula is present value of inflows divided by present value of outflows. So look, tell me, see, if PI is equal to 1, then what about NPV? If PI is equal to 1, then what about NPV? Is it 0? Is it positive? Is it negative? Or you can't say. Yes, exactly. NPV will be 0. You know, PI is equal to 1. It means inflow is equal to outflow. If inflow and outflow are equal, NPV will become 0. Right? Should I accept the proposal if NPV is 0? No, you don't divide it by average cash flow. Okay, so yes, if PI is equal to 1, NPV is 0, and in that case, proposal is actually accepted. If PI is more than 1, it means inflows are more than outflows. Is less than 1, in that case NPV will be 0. I'm sorry, NPV will be negative, and if NPV is negative, a proposal is rejected. So in case of a single independent project, how do I take decision? If PI is positive or 0, I accept it. If it is negative, I actually reject it. In case of two mutually exclusive proposals, how do I take a decision? I'll select the proposal which has higher profitability index. Suppose one has PI of 1.20 and project B has 0.4. So I'll say B is better than A and then I'll select proposal B. But usually PI method is used neither for single independent project nor for mutually exclusive projects. PI method is mostly used for capital rationing. Rationing. What is the process of rationing? You know, if the resources are scarce, resources are less, and the demand is more, then you need to divide resources in some resource demand. That is named as rationing. Like the subsidized sugar, subsidized food grain, subsidized kerosene, all these items are available at the ration shop, the fair value shop of government. And its demand is huge because it is subsidized, it is cheaper, but its supply is limited. So government divided on some suitable basis. If you are holding the BPL card, if you are holding the ration card, then on the basis of number of members in your family, we will give you the quantity of food grain or sugar or kerosene or other stuff. So if resources are less, demand is more, then you try to rationalize it. That process is named as rationing. Here also we will be doing capital rationing. Okay, now beware, you are going to answer probably wrong. Say there are 5 independent projects and all the 5 projects have positive NPV. All the 5 projects have positive NPV. How do I take a decision now? Tell me. Okay, Vrunda is saying highest NPV. Sakshi is also saying same. Meera is saying annualized NPV basis. Oh no. Oh yes, we missed one concept of ENPV. Anjali is saying highest. Jyoti is also saying highest. Priyanka is also, I told you we are going to commit the mistake, and most of you done that. I said 5 independent projects. They are not competing with each other. And if all the 5 projects have positive NPV, I will accept all 5 proposals. It's like if 5 students appear in exam and each of them score more than 50%, then what to be done? Then treat all of them to that they have passed the examination. Okay. But problem will arise if the 5 projects actually require 20 lakh rupees each or something around that. And if you accept all 5 projects, your initial investment will become 1 crore rupees, while only 70 lakh rupees are available. Yes, I want to accept all 5 because all 5 are independent and they are not related to each other and all have positive NPV. So I want to accept all, but in that case, I'll need 1 crore rupees, but my capital budget is limited up to 70 lakh rupees only. Then how do I take a decision? Then I will use PI method for the purpose of capital rationing. I'll calculate PI for all projects and then rank them according to their PI. The proposal which has highest PI will be ranked as first. The proposal which has highest PI will be ranked 1. Then second highest PI, rank 2, rank 3, rank 4, rank 5. I'll give money first to rank number 1, then to rank number 2, then to rank number 3, and then money is exhausted, suppose. Then rank 4 and 5 will be automatically rejected. This process is called capital rationing. Okay. Now, there is a fantastic situation like this. Just a moment. Suppose there is a question like this. This is project B for which you want to calculate PI. Year 2000 is actually 0 year. Okay, let's start with project A. Year 2000 is 0 year. And 2001, 2002, 2003 are first year, second year, and third year. If I want to calculate PI, now what do? It is present value of inflows divided by present value of outflows. So that's fine. But what do I do in case of project D? There is outflow in first year also. So what should I do? First year's outflow should be kept in denominator with 0 years outflow, or first year's outflow should be kept in numerator and should I net it with the inflows of second and third year? What's your opinion on this? You want to do present value of inflow upon present value of outflow. So what would you like to do? Where would we like to put first year's cash flow, which is outflow? Numerator or denominator? Just type one of the two answers. Numerator or denominator. Okay? Exactly. That's the right treatment, guys. It should be netted with other inflows. And in the denominator, only outflow for 0 years outflow should be kept. Exactly. You are doing it perfectly right. Because if you go by the wordings of the formula, then you will say, even if it is first year's outflow, I'll put it in denominator, which is a wrong approach. So the better way to word the formula is present value of cash flows other than initial cash flow, that is annual and terminal cash flow, divided by present value of initial cash flow. So better wordings for the formula are like this. Don't say present value of outflows in denominator. Say present value of initial cash flow in denominator And first year, second year, third year, fourth year, all other cash flows should be kept in numerator only. And if there is some outflow, it will be automatically net with other inflows. That is very important point. It will change your PI and eventually it will change your decision also. So you are perfectly correct. Thank you guys for being here today for a continuous time period of 3 years. Continuous time period of 3 hours. And Shruti is saying great session. Thank you, Shruti, for your kind words of appreciation. On 3rd of July and on 6th of July, be there. Thank you, Anisha. Thank you, Saranya. Looking forward for the next session. Fantastic. Just tell all the buddies who are pursuing company secretary professional course in old syllabus that to be here, because the live is live and recorded is recorded always. So the agenda for the next session is leverages, cost of capital and capital structure theories. And 6th of July agenda will be working capital, debtors, cash management and dividend policy decision. All right, guys. Bye-bye then. See you. Thank you.